Introduction to Commercial Real Estate. Commercial real estate, CRE, encompasses properties used for business activities rather than residential purposes. This broad category includes office buildings, retail centers, industrial warehouses, and multifamily apartment complexes. Investing in CRE offers distinct advantages, such as potential for significant income generation through rents and capital appreciation over time. It also provides diversification benefits within an investment portfolio, often acting as a hedge against inflation. Understanding the unique characteristics of CRE is fundamental for any aspiring investor. Unlike residential properties, CRE transactions are typically more complex, involving larger capital outlays and specialized market knowledge. This course will lay the groundwork for navigating these complexities effectively. Differentiating CRE from residential real estate is crucial for proper investment strategy. Residential properties are primarily for housing individuals or families, whereas CRE serves commercial enterprises, generating revenue through business operations or services. The valuation metrics, financing structures, and legal frameworks for CRE are distinct and require specialized expertise. Investors often seek CRE for its stable cash flow potential and its ability to provide tangible assets that can appreciate in value. This sector demands a thorough understanding of market cycles, tenant dynamics, and property management principles to maximize returns and mitigate risks. A solid foundation in these areas is indispensable for long-term success. Types of commercial properties. Commercial real estate is diverse, encompassing several primary property types, each with unique investment characteristics and market drivers. Office properties range from central business district high-rises to suburban office parks, catering to various business needs. Retail properties include shopping centers, strip malls, and standalone stores, all dependent on consumer spending and demographics. Industrial properties, such as warehouses, manufacturing facilities, and distribution centers, are crucial for logistics and supply chain operations. These properties are often valued based on their functional utility and access to transportation networks, making location a paramount factor for success. Multifamily properties, while residential in nature, are considered commercial investments when they consist of 5 or more dwelling units, such as apartment buildings and complexes. Hospitality properties, including hotels, motels, and resorts, are performance-based investments, heavily influenced by tourism and economic cycles. Other specialized categories include healthcare facilities, self-storage units, and data centers, each requiring specific market knowledge and management expertise. Investors often choose a property type based on their risk tolerance, investment goals, and understanding of the specific sector's market dynamics. Diversifying across different property types can also help mitigate risks within a portfolio. Key players in CRE investment. The commercial real estate investment landscape involves a diverse array of professionals, each playing a critical role in facilitating transactions and managing assets. Investors, ranging from individual high-net-worth individuals to large institutional funds, are the capital providers seeking returns from property ownership. Real estate brokers act as intermediaries, connecting buyers and sellers and possessing deep market knowledge to guide transactions. Lenders, including banks, credit unions, and private equity firms, provide the necessary financing for acquisitions and development projects. Their expertise in risk assessment and loan structuring is vital for the capital flow in the market. Understanding the roles and motivations of these key players is essential for successful navigation of the CRE market. Developers are responsible for creating new properties or redeveloping existing ones, transforming raw land or underutilized assets into income-generating properties. Property managers oversee the day-to-day operations of commercial properties, ensuring tenant satisfaction, maintenance, and financial performance. Appraisers provide independent expert opinions on property values, which are crucial for financing, sales, and investment analysis. Legal counsel and environmental consultants also play significant roles, addressing regulatory compliance and mitigating potential risks. Collaborating effectively with these various stakeholders is paramount for executing complex commercial real estate investment strategies and achieving desired financial outcomes. Each professional contributes specialized knowledge that is indispensable to the investment process. Understanding market cycles. Commercial real estate markets are inherently cyclical, moving through distinct phases that significantly impact investment opportunities and risks. These cycles are typically influenced by broader economic conditions, interest rates, employment growth, and population shifts. The four main phases are recovery, expansion, hypersupply, and recession. During the recovery phase, occupancy rates begin to rise, and rents stabilize after a downturn, signaling potential for future growth. Understanding these cyclical patterns allows investors to time their acquisitions and dispositions more effectively, optimizing their returns and minimizing potential losses. Recognizing the current phase of the market cycle is a critical skill for any CRE investor. The expansion phase is characterized by increasing demand, rising rents, and new construction, often leading to strong investment returns. However, this can eventually lead to the hypersupply phase, where new construction outpaces demand, resulting in rising vacancies and slowing rent growth. Finally, the recession phase sees declining demand, falling rents, and increasing vacancies, often accompanied by economic contraction. Each phase presents unique challenges and opportunities. For instance, acquisitions during a recession can yield significant long-term gains if timed correctly. Conversely, selling during a hypersupply phase might prevent losses from oversupply. Astute investors analyze various economic indicators to anticipate these shifts and adjust their strategies accordingly. Fundamentals of CRE valuation. Commercial real estate valuation is the process of determining a property's economic value, which is crucial for investment decisions, financing, taxation, and legal purposes. Unlike residential properties, CRE valuation often focuses heavily on the income-generating potential of the asset. Investors need to understand how to accurately assess a property's worth to ensure they are making sound investment choices and avoiding overpaying. A precise valuation helps in negotiating fair prices, securing appropriate financing, and understanding potential returns. It forms the bedrock of any successful commercial real estate investment strategy, providing a quantitative basis for decision-making. Without robust valuation, investment risks are significantly amplified. Several approaches are commonly used in CRE valuation, each providing a different perspective on a property's worth. The primary methods include the income capitalization approach, the sales comparison approach, and the cost approach. Each method has its strengths and weaknesses, and the most appropriate approach often depends on the property type, market conditions, and the availability of data. A comprehensive valuation typically involves applying multiple methods and reconciling the results to arrive at a well-supported estimate of value. Mastering these valuation techniques is fundamental for any commercial real estate investor seeking to identify profitable opportunities and manage their portfolio effectively. This analytical skill is indispensable for long-term success in the market. Income capitalization approach. The income capitalization approach is a primary method for valuing income-producing commercial properties, focusing on the property's ability to generate future income. This method converts a property's net operating income, NOI, into a present value using a capitalization rate, cap rate. NOI is calculated by subtracting all operating expenses from the property's gross operating income, excluding debt service and income taxes. The cap rate, derived from comparable sales or market analysis, represents the rate of return an investor expects on a property. This approach is particularly relevant for properties like office buildings, retail centers, and multifamily complexes, where rental income is the main driver of value. It provides a direct link between a property's earning potential and its market value. The basic formula for the income capitalization approach is value equals net operating income, NOI. divided by capitalization rate cap rate. A higher NOI generally leads to a higher property value, assuming the cap rate remains constant. Conversely, a lower cap rate, indicating lower perceived risk and higher demand, will also result in a higher property value for a given NOI. Investors frequently use this method to compare investment opportunities, as it provides a standardized metric for evaluating potential returns. Understanding how to accurately calculate NOI and select an appropriate cap rate is critical for applying this valuation method effectively and making informed investment decisions in the commercial real estate market. Sales comparison approach. The sales comparison approach, also known as the comparable sales or market data approach, estimates a property's value by comparing it to similar properties that have recently sold in the same market. This method is based on the principle of substitution, which states that a prudent buyer would not pay more for a property than the cost of acquiring a similar, equally desirable substitute. Appraisers identify recently sold properties that are highly comparable to the subject property in terms of location, size, age, condition, and property type. The effectiveness of this approach heavily relies on the availability of sufficient and reliable sales data. It is widely used across all commercial property types, especially when there is an active market with frequent transactions. Once comparable sales are identified, adjustments are made to their sale prices to account for differences between the comparable properties and the subject property. These adjustments can include variations in property features, amenities, market conditions at the time of sale, and financing terms. For example, if a comparable property has a swimming pool and the subject property does not, an adjustment would be made to reduce the comparable's sale price. The goal is to adjust the comparable sales to reflect what they would have sold for if they were identical to the subject property. After making all necessary adjustments, the adjusted sale prices of the comparable properties are reconciled to arrive at a final value estimate for the subject property. This approach provides a market-driven perspective on value. Cost approach to valuation. The cost approach to valuation estimates a property's value by calculating the cost to replace or reproduce the existing improvements, then subtracting any depreciation, and finally adding the value of the land. This method is based on the principle that a prudent investor would not pay more for a property than the cost to build a new, equally desirable substitute. It is particularly useful for valuing newer properties, specialized properties with limited comparable sales, or properties where income data is scarce. For example, a newly constructed school or a unique manufacturing plant might be best valued using this approach. The cost component includes both direct construction costs and indirect costs, such as architectural fees and permits. Depreciation in the context of the cost approach refers to the loss in value from all causes, not just physical wear and tear. It includes physical deterioration, functional obsolescence, example, outdated design, and external obsolescence, example, negative economic factors. Accurately estimating depreciation is often the most challenging aspect of this method. The land value is typically determined using the sales comparison approach, as land itself does not depreciate. By combining the depreciated cost of improvements with the land value, the cost approach provides a comprehensive estimate of a property's worth. This method offers a valuable perspective, especially for properties where market data or income streams are not readily available or reliable. Financing. Commercial real estate financing is a critical component of commercial real estate investment, as most acquisitions and developments require substantial capital beyond an investor's immediate funds. Understanding the various sources of debt and equity is paramount for structuring viable deals. Commercial mortgages from banks, credit unions, and life insurance companies are common forms of debt financing, typically secured by the property itself. These loans often have different terms, interest rates, and amortization schedules compared to residential mortgages. Investors must carefully evaluate loan-to-value (LTV) ratios and debt service coverage ratios (DSCR) to ensure the property can support the debt obligations. Proper financing can significantly enhance investment returns while poor financing choices can lead to financial distress. Equity financing involves capital provided by investors in exchange for an ownership stake in the property. This can come from individual investors, syndications, private equity funds, or real estate investment trusts, REITs. Often, a combination of debt and equity is used to fund a commercial real estate project known as a capital stack. The balance between debt and equity influences the risk and return profile of an investment. Higher leverage, more debt, can amplify returns but also increases risk. Investors must strategically choose their financing partners and structures to align with their investment goals and risk tolerance. A well-crafted financing strategy is as important as the property selection itself for long-term success. Debt and equity structures. Understanding the nuances of debt and equity structures is crucial for optimizing the capital stack of a commercial real estate investment. Senior debt, typically provided by traditional lenders like banks, sits at the bottom of the capital stack, meaning it has the highest priority for repayment. It usually carries the lowest risk and, consequently, the lowest interest rate. Mezzanine debt is a hybrid form of financing, ranking below senior debt but above equity. It offers higher returns to lenders due to its increased risk, often structured with a combination of interest payments and an equity kicker. These structures are vital for balancing risk and return in complex transactions. Investors must carefully consider the implications of each layer on their overall financial exposure. Preferred equity occupies a position above common equity but below mezzanine debt, receiving preferential treatment in terms of distributions and repayment. It often comes with a fixed return and may have some voting rights. Common equity, at the top of the capital stack, represents the riskiest position but also offers the highest potential returns. Common equity investors are typically the last to be paid in a liquidation scenario, but benefit most from property appreciation. The selection and layering of these debt and equity components directly impact the project's overall cost of capital, risk profile, and potential for investor returns. Strategic deployment of these structures can significantly enhance investment performance. Investment strategies: core, value-add, opportunistic, commercial real estate investment strategies can generally be categorized into three main types: core, value-add, and opportunistic, each with distinct risk-return profiles. Core investments involve acquiring stable, fully leased, high-quality properties in prime locations with predictable cash flows. These properties typically require minimal management and offer lower but consistent returns, making them suitable for risk-averse investors seeking long-term income. Examples include Class A office buildings in major cities or well-established retail centers. The focus here is on capital preservation and steady income rather than aggressive growth. This strategy is often favored by institutional investors and pension funds seeking stable, inflation-hedged returns. Value-add strategies involve acquiring properties that require some level of improvement or repositioning to increase their value and cash flow. This could include renovating outdated spaces, improving property management, or releasing vacant units. These investments carry moderate risk but offer higher potential returns than core properties. The goal is to create value through active management and strategic enhancements. Opportunistic strategies involve acquiring distressed properties, developing new projects, or investing in highly speculative assets. These are the riskiest investments, but offer the highest potential returns, often involving significant capital expenditure and a longer investment horizon. Understanding these strategies helps investors align their risk tolerance with appropriate investment opportunities. Risk assessment in CRE investment. Commercial real estate investment inherently involves various risks that must be thoroughly assessed and managed to protect capital and achieve desired returns. Market risk, for instance, arises from fluctuations in economic conditions, supply and demand imbalances, and changes in property values. Credit risk pertains to the financial health of tenants and their ability to meet lease obligations, directly impacting a property's cash flow. Interest rate risk refers to the potential negative impact of rising interest rates on financing costs and property valuations. Understanding these risks is the first step towards developing effective mitigation strategies. A comprehensive risk assessment helps investors anticipate potential challenges and build resilience into their portfolios. Liquidity risk is another significant factor, as commercial properties are generally illiquid assets, meaning they cannot be quickly converted to cash without a substantial loss in value. Operational risks stem from poor property management, unexpected maintenance issues, or tenant disputes. Environmental risks, such as contamination or natural disasters, can also significantly impact property value and liability. Investors must conduct thorough due diligence to identify and quantify these risks before committing capital. Developing robust risk management plans, including diversification, insurance, and contingency planning, is essential for navigating the unpredictable nature of the commercial real estate market and safeguarding investments over the long term. Due diligence process. The due diligence process is a critical and comprehensive investigation conducted by a prospective buyer to assess the risks and opportunities associated with a commercial real estate acquisition. This meticulous examination occurs after a purchase agreement is signed, but before the final closing. It involves a detailed review of all aspects of the property, including its financial performance, legal status, physical condition, and environmental considerations. The primary goal is to uncover any hidden liabilities or material facts that could negatively impact the investment's value or future profitability. A thorough due diligence process helps investors make informed decisions and avoid costly surprises after acquisition. Key components of due diligence include financial due diligence, which involves scrutinizing income and expense statements, lease agreements, and tenant creditworthiness. Legal due diligence focuses on title searches, zoning compliance, existing contracts, and potential litigation. Physical due diligence entails property inspections by engineers and contractors to assess structural integrity, HVAC systems, and overall condition. Environmental due diligence investigates potential contamination or hazardous materials on the site. Each of these areas requires specialized expertise and careful documentation. The findings from due diligence can lead to renegotiation of terms, adjustments to the purchase price, or even termination of the deal if significant issues are uncovered. It is an indispensable step for mitigating risks. Lease analysis and tenant relations. Lease analysis is a critical skill for commercial real estate investors, as lease agreements dictate the income stream and operational responsibilities of a property. Understanding different lease types, such as gross, net, and triple net (NNN), is fundamental. A gross lease means the landlord pays for all operating expenses, while a net lease shifts some expenses to the tenant. A triple net lease, common in industrial and retail properties, requires the tenant to pay for property taxes, insurance, and maintenance, in addition to rent. Thoroughly reviewing lease terms, including rent escalations, renewal options, and tenant improvement allowances, is essential for accurately projecting cash flows and assessing investment viability. The quality and stability of tenant leases directly impact a property's value. Effective tenant relations are paramount for maximizing property value and ensuring long-term investment success. Maintaining strong relationships with tenants can lead to higher retention rates, reduced vacancy periods, and improved property performance. Proactive communication, prompt resolution of maintenance issues, and fair lease negotiations contribute to tenant satisfaction. A high-quality tenant base with strong creditworthiness is a significant asset, as it provides stable income and reduces default risk. Investors must also understand the legal aspects of leases, including eviction procedures and compliance with landlord-tenant laws. Strategic lease analysis, combined with excellent tenant relations, forms the backbone of a profitable commercial real estate investment, ensuring consistent income and minimizing operational headaches. Property management essentials. Effective property management is crucial for preserving and enhancing the value of commercial real estate investments. It encompasses a wide range of responsibilities, from day-to-day operations and maintenance to financial reporting and tenant relations. A skilled property manager ensures the property is well maintained, functional, and appealing to tenants, which directly impacts occupancy rates and rental income. This includes overseeing repairs, coordinating services, and implementing preventative maintenance programs to extend the lifespan of building systems. Proactive management minimizes operational disruptions and helps maintain a positive reputation for the property. Investors often delegate these tasks to professional property management firms, allowing them to focus on broader investment strategies. Financial management is another core aspect of property management, involving rent collection, expense tracking, budget creation, and preparing detailed financial reports for investors. These reports provide transparency and allow investors to monitor the property's performance against their investment goals. Marketing and leasing activities are also vital, ensuring vacant spaces are filled with qualified tenants quickly and efficiently. Property managers are responsible for lease negotiations, tenant screening, and ensuring compliance with all legal and regulatory requirements. By effectively managing these diverse functions, property managers play a pivotal role in maximizing a property's net operating income and, consequently, its overall market value. Their expertise is indispensable for long-term investment success. Tax implications of CRE investment. Understanding the tax implications of commercial real estate investment is crucial for maximizing returns and ensuring compliance. One of the most significant tax benefits is depreciation, which allows investors to deduct a portion of the property's value, excluding land, over its useful life, reducing taxable income. This non-cash expense can significantly lower an investor's tax liability, effectively boosting cash flow. However, investors must be aware of depreciation recapture rules upon sale. Capital gains taxes are another key consideration, applied to the profit realized when a property is sold for more than its adjusted basis. Strategic tax planning is essential to navigate these complexities and optimize after-tax returns. A 1031 exchange, also known as a like-kind exchange, is a powerful tax deferral strategy that allows investors to defer capital gains taxes when selling an investment property, provided they reinvest the proceeds into another like-kind property within specific timeframes. This strategy can be instrumental in building wealth over time by continually reinvesting capital without immediate tax burdens. Property taxes, based on the assessed value of the property, are an ongoing operating expense that varies by jurisdiction. Investors must also consider state and local income taxes, transfer taxes, and potential sales taxes on certain property-related services. Consulting with a qualified tax advisor is highly recommended to develop a tailored tax strategy that aligns with investment goals and minimizes tax burdens legally. Legal aspects and regulations. Commercial real estate investment is governed by a complex web of legal aspects and regulations that investors must navigate carefully. Zoning laws, enacted by local governments, dictate how land can be used and what types of structures can be built on it. Understanding these regulations is critical before acquiring or developing a property, as non-compliance can lead to costly delays or project abandonment. Land use regulations, building codes, and environmental protection laws further impact development and operational activities. These legal frameworks are designed to ensure public safety, environmental sustainability, and orderly urban development. Investors must conduct thorough legal due diligence to identify any potential regulatory hurdles or compliance issues. Contracts are central to commercial real estate transactions, including purchase agreements, lease agreements, and financing documents. Each contract must be meticulously reviewed by legal counsel to protect the investor's interests and ensure enforceability. Property law, including title and ownership rights, easements, and liens, forms the foundation of real estate transactions. Environmental regulations, such as those governing hazardous waste or wetlands, can impose significant liabilities if not properly addressed. Staying informed about changes in local, state, and federal laws is essential for mitigating legal risks and ensuring the long-term viability of commercial real estate investments. Engaging experienced legal professionals is indispensable for navigating these intricate legal landscapes effectively. Exit strategies for CRE investments. Developing a clear exit strategy is as important as the initial acquisition in commercial real estate investment. An exit strategy outlines how an investor plans to dispose of a property to realize profits or minimize losses. Common exit strategies include selling the property, refinancing it, or holding it for continued income generation. The choice of strategy depends on various factors, including market conditions, the property's performance, the investor's financial goals, and the initial investment horizon. A well-defined exit strategy helps investors make timely decisions and avoid being forced into unfavorable situations. It provides a roadmap for realizing the full potential of the investment. Selling the property is the most straightforward exit, typically aiming to capitalize on appreciation. This involves marketing the property, negotiating with buyers, and completing the transaction. Refinancing allows investors to extract equity from a property, often to fund new investments or return capital to partners, while retaining ownership. This strategy is attractive in a low-interest rate environment or when the property's value has significantly increased. Holding the property indefinitely for long-term cash flow is another viable strategy, particularly for core assets with stable tenants. Market timing plays a crucial role in all exit strategies. Understanding when to sell, refinance, or hold requires continuous market analysis and strategic foresight. Flexibility in exit planning is key to adapting to changing market dynamics and achieving optimal outcomes. Emerging trends in CRE. The commercial real estate landscape is continuously evolving, driven by technological advancements, changing demographics, and shifting societal values. Emerging trends present both challenges and opportunities for investors. Technology integration, such as smart building systems, IoT devices, and AI-powered property management platforms, is transforming how properties are operated and experienced. These innovations can enhance efficiency, reduce costs, and improve tenant satisfaction, ultimately increasing property value. Investors must stay abreast of these technological shifts to remain competitive and identify properties that are future-proofed. Embracing PropTech solutions is becoming increasingly vital for optimizing performance and attracting modern tenants. A digital transformation is reshaping every aspect of the CRE industry. Sustainability and environmental, social, and governance (ESG) factors are gaining significant prominence, with a growing demand for green buildings and energy-efficient properties. Investors are increasingly prioritizing properties with strong ESG credentials due to regulatory pressures, tenant preferences, and long-term value creation. Flexible workspaces, including co-working spaces and adaptable office layouts, are also on the rise, catering to the evolving needs of businesses for agility and collaboration. The shift towards remote and hybrid work models is further influencing demand for different types of office spaces. Understanding these emerging trends allows investors to anticipate future market demands, adapt their strategies, and position their portfolios for sustainable growth and enhanced returns in a rapidly changing world. Building a CRE investment portfolio. Constructing a well-diversified commercial real estate investment portfolio is essential for mitigating risk and achieving long-term financial objectives. Diversification can be achieved across various dimensions, including property types, for example, office, retail, industrial, geographic locations, tenant industries, and investment strategies, e.g., core, value-add. A balanced portfolio reduces the impact of underperformance in any single asset or market segment. For instance, a downturn in the retail sector might be offset by strong performance in industrial logistics. Strategic asset allocation, based on an investor's risk tolerance and return goals, guides the composition of the portfolio. This thoughtful approach ensures resilience against market fluctuations and optimizes overall returns. Long-term strategy involves setting clear investment goals, defining a target risk-return profile, and regularly rebalancing the portfolio to maintain desired allocations. This includes continuous monitoring of market conditions, property performance, and tenant quality. Investors might gradually shift their portfolio composition over time, perhaps moving from more opportunistic investments to core assets as they approach retirement or seek more stable income. The use of financial models and analytical tools helps in assessing portfolio performance and identifying opportunities for optimization. Building a successful CRE portfolio is an ongoing process that requires discipline, adaptability, and a deep understanding of market dynamics. A well-constructed portfolio serves as a powerful wealth-building vehicle over decades.